So for 50 years, I mean, if you heard the name Nordson Corporation, you probably thought about cereal boxes.
Oh yeah, or diapers, like all that everyday stuff.
Right, exactly. Or just those highly engineered, but ultimately very, traditional machines that apply industrial glues and coatings.
Just the background noise manufacturing that keeps the whole GDP humming along.
Yeah, but today, if you actually look inside the most advanced hyperscale AI data centers on the planet, which is crazy to think about, those same underlying fluid dispensing technologies are what is keeping the next generation of semiconductors from quite literally melting down.
It's wild. It is a complete identity shift for the company.
It really is. And so welcome to a special Talk Tickers edition of the Deep Dive. We are putting Nordson, that's ticker symbol NDSN, under the microscope today.
We're looking closely at their Q2 2026 earnings.
Exactly. We want to figure out if Wall Street is fundamentally mispricing a company that is quietly built like a backdoor into the global AI infrastructure boom.
And that is the exact right question to ask, because the market has a serious lag when it comes to updating a company's core identity.
Oh, for sure. People get anchored to the past.
Right, so NDSN still trades in a lot of portfolios as this defensive industrial play, a safe haven for uncertain times.
Which, I mean, it still is, right? That floor definitely still exists.
It does. But the Q2 transcript reviews a completely different ceiling. We are looking at an operational pivot where over 50% of their portfolio is now heavily entrenched in these high-growth end markets.
You're talking about the advanced electronics, the medical devices, and that complex semiconductor packaging.
Exactly. And the tension we need to resolve for anyone holding or even just considering this stock is whether they are successfully managing this dual identity.
We have an absolute mountain of data to unpack from this quarter, so let's just jump straight into the headline number.
Let's do it. Hit me with the vital signs.
Okay, so on the top line, they posted a second quarter record, $741 million in revenue.
Which is a solid 8% year-over-year jump.
Yeah, an 8% jump. But crucially, and this is the part I love, 7% of that was organic growth.
Right, which is the number everyone should be circling.
Absolutely. Because when you factor out like the 3% currency tailwind, and then they had a recent medical divestiture, plus a minor bolt-on acquisition, that 7% organic number tells a very aggressive story.
It really does. It speaks directly to their pricing power and volume in an industrial landscape that has honestly been pretty stagnant.
Right. Like nobody is posting those kinds of organic numbers right now.
No, they aren't. And that 7% organic number is really the critical anchor for this entire analysis.
Because organic means they're actually selling more stuff, right? Not just financial engineering.
Exactly. I mean, we look at the broader macro environment throughout early 2026. We've seen purchasing managers' indices just fluctuating wildly.
Yeah, a lot of capital expenditure delays across heavy industry too.
Right, and just a general hesitation from OEMs to build any sort of inventory. So finding 7% pure organic volume and price expansion in that specific climate.
It's huge.
It means Nordson's end markets are fundamentally disconnected from the broader industrial slowdown. The underlying engine is just pulling harder than the macroeconomic current.
And that operational leverage, I mean, it flowed straight down the income statement. They reported an adjusted EPS of $2.86.
Which is an 18% year-over-year increase?
Yeah, an 18% bump that actually cleared the midpoint of management's own guidance by 6 cents, which is like hitting a home run in this environment.
And they posted record EBITDA of $235 million, which preserves a really healthy 32% EBITDA margin.
But, and here's where I want to push back a little. If we dig into the analyst Q&A, CFO Dan Hopgood had to defend a metric that, at least initially, looks like a bit of a red flag.
Ah, you're talking about the incremental EBITDA contribution.
Yeah, exactly. It came in at 31%. And in a vacuum, for a company that historically targets incremental margins in the high 30s.
And actually printed incrementals in the 50% range last year, let's not forget.
Right, so dropping to 31%, that looks like their cost structure is suddenly, I don't know, bloating or something. Is this a crack in the foundation?
Well, a surface level read definitely triggers that concern, but we really have to dissect the mechanics of what is actually driving that margin contraction.
Okay, so what did Hopgood say?
He was very direct about the inflationary realities of their supply chain. I mean, they are absorbing significantly higher costs on resins, on basic electrical components, and just the cascading effects of recent tariffs.
Right, everything is getting more expensive.
Exactly. So in a severe inflationary environment, Just maintaining a 32% overall EBITDA margin is an incredibly heavy lift.
That makes sense. Most of their industrial peers are currently reporting margin compression, right?
Oh, absolutely. Because the lag time between absorbing a higher raw material cost and actually passing that cost on to the end customer through a price hike that takes quarters to execute.
I like to think of it as a shock absorber effect. The macroeconomic road got incredibly bumpy with all this material inflation and supply chain friction, but Nordson's pricing power basically acted as a dynamic suspension system.
That's a great analogy.
Right, so the incremental margin took the initial hit dropping to that 31%. But the overall corporate profitability chassis just stayed perfectly level at 32%.
They didn't lose ground. They just absorbed the impact without passing the volatility on to their ultimate bottom line.
And Hopgood even noted that 31% is actually a 300 basis point improvement sequentially from Q1. So the shock absorbers are actually stiffening as the year progresses.
Exactly. And the real confirmation of that pricing power lies in where that revenue is actually being generated.
You're talking about the segments now.
Yeah.
The story behind the number.
Right. If we look at the Advanced Technology Solutions segment, or ATS, they posted an all-time quarterly record of $178 million.
Wow. And what was the organic growth there?
8% organic growth. This is the absolute star of the quarter, the segment spearheading that AI and semiconductor pivot we talked about.
Which is wild because historically, semiconductor capital equipment is notoriously cyclical.
Oh, brutally so.
Yeah.
We've all seen the boom and bust cycles in memory chips where equipment providers just suffer these massive revenue drawdowns.
Yeah, it's feast or famine. But CEO Sundaram Nagarjan, he goes by Naga on the calls, he highlighted that the ATS division completely re-architected their operating model after the last downturn.
Using what they call their NBS Next growth framework.
Right, which, to be honest, sounds like standard management consulting jargon until you actually look at the physical execution on the factory floor.
Yeah, it's not just a buzzword.
No, they didn't just tweak their product mix. They radically decentralized their engineering footprint. They physically moved their R&D and support teams to sit directly adjacent to the major semiconductor fabrication plants globally.
Which is such a smart structural move. When a major fab is spinning up a new node, Nordson isn't like flying an engineer out from headquarters in Ohio to troubleshoot a fluid dispenser.
Right. They are already in the building. They're co-developing the manufacturing process in real time.
And that physical proximity just alters the entire feedback loop of product development. And it's vital right now because the complexity of what they are manufacturing has fundamentally shifted.
Because they aren't just putting a little dot of underfill on a standard logic chip anymore, right?
No, not at all. The massive bottlenecks in modern AI compute are thermal management and data transfer speed. The sheer size of the GPUs powering these large language models, they generate so much heat and require such dense connections that traditional soldering and packaging methods just physically fail.
Okay, let's break down the physics of that for a second, because I think it's the core of the whole ATS thesis for investors.
Go for it.
When you have literally billions of transistors firing on an AI chip, you run into the harsh limits of thermodynamics. You can't just slap a basic heat sink on it and call it a day.
Right, it would just melt.
Exactly. So the industry is moving to what management called panel-level packaging. Instead of packaging chips individually, they're integrating multiple chiplets, like the CPU, the memory, the logic all, onto a single, massive high-density panel.
And the tolerances required for that are insane.
They're measured in microns. To dispense the protective epoxies, the thermal interface materials, and the underfills between these microscopic components, if the fluid dynamic of that epoxy is off by even a fraction of a percent, the chip either shorts out or melts down under load.
And that extreme tolerance requirement, that is Nordson's economic moat.
Right there.
The ATS segment is providing the highly engineered automated dispensing systems that apply those materials with absolute precision, but at mass manufacturing speeds.
Which is the hardest part. Doing it perfectly once is hard. Doing it a million times an hour is a completely different game.
Exactly. Furthermore, the data transfer bottleneck is forcing the adoption of optical fibers directly into the chip package.
Because you need to move data between server racks at the speed of light.
Right, not through copper wiring, which degrades the signal and just generates even more heat. And guess who is supplying the precision alignment and dispensing technology required to bond those optical fibers directly to the silicon?
Nordson.
Nordson. The fabs literally cannot scale AI infrastructure without this specific, highly niche manufacturing equipment.
Which totally explains why Naga believes they are only in the very early innings of this semiconductor demand cycle. I mean, the hardware architecture for AI is still actively being invented.
And Nordson is embedded at the ground level of that invention.
Okay, so that's ATS providing the high beta growth.
Yeah.
But I want to look at the medical and fluid solutions segment, MFS, because that offers a very different kind of durability.
Yeah, MFS is fascinating. They reported $213 million in sales with 8% organic growth, which confirms a really strong rebound in medical end markets.
Right. But, and here's my pushback, the EBITDA margins in the segment actually compressed year over year.
They did, yeah.
And in a high-margin business like medical components, an 8% jump in organic volume should naturally expand margins through operating leverage. So why are margins shrinking if they're growing organically by 8%?
It's a great question. And the transcript reveals a highly localized, acute operational bottleneck. It's not a systemic issue.
Okay, so what exactly happened?
Hopgood detailed a near-term product startup headwind that was isolated within specific interventional medical product lines. He categorized it as a regulatorily required material change.
Okay, what does that actually mean on the factory floor?
Well, in the manufacturing of interventional devices, we're talking catheters, stents, delivery systems that physically enter the human body. The materials used are under the absolute jurisdiction of global regulatory bodies like the FDA.
Right, you can't mess around with that stuff.
Exactly. So if a regulatory standard shifts, or even if a supplier just alters the chemical composition of a biocompatible polymer slightly, the manufacturer is legally mandated to validate that new material.
Oh, wow. And validating a new material in a medical clean room has got to be a brutal, capital-intensive process.
It is. You don't just swap the resin drum and hit the start button.
Right. The entire manufacturing line has to halt because the new polymer might have a slightly different melt temperature, or maybe the viscosity is off, which means Nordson's extrusion and dispensing equipment must be completely recalibrated.
Yep. You have to run test batches, document all the failure rates, recertify the clean room environment, and then submit those massive validation protocols back to the regulator.
So all that downtime, the scrap material generated during testing, and the expensive engineering hours required to execute the changeover, that's just a pure margin killer.
It creates a temporary black hole for operational efficiency. But the crucial takeaway for you, the investor, is that this is a transient, mechanical inefficiency.
It's not a collapse in demand.
Exactly. It's not a structural decline in the market or a loss of pricing power against competitors. Management was explicit that the validation process is tracking exactly to schedule.
And once that newly certified line hits full production speed again, that margin drag just vanishes.
It does. In fact, management says this headwind will actually become an opportunity later in the year. These regulatory hurdles actually reinforce Nordson's competitive position in a weird way.
How so? Like a barrier to entry?
Completely. The sheer cost and complexity of executing a mid-cycle material changeout in a Class 3 medical device environment prevents smaller, cheaper competitors from easily entering the market. The margin hit today is essentially the price of maintaining a near monopoly tomorrow.
Okay, that makes a lot of sense.
Yeah.
So moving to the legacy core of the business, the Industrial Precision Solutions segment, or IPS.
The classic Nordson.
Right, the glue and coatings. They posted a record $350 million in total sales, driven by 5% organic growth. But honestly, the real story unfolding in IPS this quarter isn't just the steady organic growth.
No, it's how they are weaponizing their balance sheet to acquire adjacent technology.
Yes, the capital allocation. So the company generated $170 million in free cash flow, which represents well over 100% conversion of their net income.
Which is an incredible metric. For every dollar of accounting profit, they generated over $1 of actual unencumbered cash.
And they deployed this really well. They paid $46 million in dividends, bought back $50 million in shares, and then took a fraction of that cash and executed a highly targeted acquisition.
Right. They bought a North American precision agriculture company called Capstan AG.
Now, at first glance, a $3 billion global industrial player paying 9 times adjusted EBITDA for a company in Topeka, Kansas that does like $13 million a year in revenue. It seems totally insignificant.
It barely moves the needle on the consolidated income statement.
Right. But strategic M&A is rarely about buying immediate revenue, is it?
No, it's about acquiring proprietary technology and market access. And Capstan specializes in pulse width modulation systems for commercial agriculture.
Okay, let's translate the fluid dynamics of pulse width modulation, or PWM, because it directly maps back to Nordson's core competency.
Yeah, break that down because it's fascinating.
So In large-scale commercial farming, you have these massive tractors pulling sprayer booms that can be like 120 feet wide, and they are applying fertilizers, herbicides, pesticides, whatever.
Huge scale.
Yeah. But historically, the pressure of the fluid coming out of the nozzles was entirely dependent on the speed of the tractor. So if the tractor slowed down to turn around at the end of a field, the pressure dropped.
Which alters the spray pattern and the droplet size, right?
Exactly, leading to uneven chemical application.
Yeah.
It is wildly inefficient, it's expensive, and frankly, it's environmentally destructive.
Yeah.
Because farmers inevitably just over-apply to assure they get adequate coverage.
Right, they just spray extra to be safe. But PWM entirely decouples the fluid pressure from the tractor speed.
How does it do that mechanically?
The system places a tiny electronic solenoid valve on every single individual nozzle across that massive 120-foot boom. Instead of a continuous flow, the valve rapidly pulses open and closed, often 10 to 30 times a second.
Wow, 30 times a second.
Yeah, and by modulating the width of that pulse, meaning the exact fraction of a second the valve remains open, the system controls the precise volume of liquid dispensed without altering the underlying line pressure.
So the droplet size remains perfectly constant whether the tractor is crawling at 2 miles an hour or accelerating up to 15.
Exactly. It's essentially applying factory-level fluid dispensing precision to a highly unpredictable outdoor agricultural environment.
That is brilliant. Nordson already dominates precision dispensing indoors. Capstan just gives them the proprietary IP to dominate it out in a cornfield.
And crucially, it gives them immediate, deeply integrated relationships with the mid-tier agricultural original equipment manufacturers in North America.
Because they already acquired some European agricultural tech recently, right?
Yeah, through the AR deal. So they are actively consolidating that European tech into Capstan's physical footprint in the U.S. heartland, completely closing the loop on that close to the customer operational model we talked about earlier.
Okay, so that covers the operational segments. But alongside that strategic M&A, the Q2 transcript detailed a masterstroke in corporate finance that completely insulated their balance sheet from a massive vector of long-term risk.
Oh, you mean the pension move?
Yeah. They executed a pension annuitization, transferring $113 million of their U.S. defined benefit pension obligation completely off their books.
And they secured this risk transfer at a 7.5% discount rate without utilizing a single dollar of corporate cash.
Which is wild. Now, for investors who might glaze over at the mere mention of pension accounting, this move is critical to understand. Because legacy defined benefit plans are essentially ticking time bombs on an industrial balance sheet.
They really are. When a company promises to pay retirees a fixed income for life, they bear dual risks.
Market risk and mortality risk, right?
Exactly. Market risk means the investments funding the pension might underperform. And mortality risk means the retirees might live significantly longer than the actuarial tables predict.
And if either of those scenarios plays out, the company has to suddenly divert free cash flow away from R&D or dividends and just dump it into the pension fund to cover the shortfall.
Right. But by executing an annuitization, which basically means buying a group annuity contract from an insurance provider, Nordson permanently offloaded both the market and mortality risk for that specific $113 million liability.
So the insurance company now bears the mathematical burden.
Exactly. And securing that transfer at a 7.5% discount rate is just a phenomenal piece of timing. In an elevated interest rate environment like we have right now, the present value of those future liabilities decreases.
Which allowed Nordson to settle this obligation highly efficiently.
Yep. Now, they did recognize a $24 million charge on the income statement related to this move.
Right, but Hopgood clarified that, didn't he?
He did. That charge is a purely non-cash, pre-tax accounting requirement just to recognize unamortized actuarial losses. It doesn't impact their operational cash flow by a single cent.
So they permanently de-risked the balance sheet using assets already trapped inside the pension plan itself. That is incredibly clean.
It's textbook balance sheet management.
All right, so with the balance sheet fortified and the operational segments actually expanding margins against an inflationary backdrop, we have to look forward. Let's pivot to management's guidance because ultimately markets price in the future, not the past.
Okay, let's look at what they're signaling for the back half of 2026.
They issued Q3 guidance forecasting sales between $760 and $790 million An adjusted EPS of $2.95 to $3.15.
But more importantly, they raised their full-year guidance across the board.
Yeah, they bumped total sales to a range of $2.93 billion to $3.01 billion and bumped adjusted EPS to between $11.30 and $11.80.
Upward guidance revisions mid-year require a supreme level of visibility into the sales pipeline. Management is actively putting their credibility on the line here.
And the empirical data point driving that confidence, their order backlog, which surged 18% organically year over year, that is the ultimate leading indicator.
Right. And Naga noted that order velocity actually accelerated in the final months of Q2 and maintained that exact same trajectory right into the early weeks of Q3.
With broad-based demand across all three segments.
Yeah. And we also received clarity on the currency situation. That 3% foreign exchange tailwind from the first half of the year, management says that will neutralize in the second half.
Oh, so this raised guidance relies entirely on the core business executing on that massive backlog.
Exactly. There's no macro currency fluff propping up the back half of the year.
But let me play devil's advocate for a second, because the quality of that 18% backlog is really the crux of the investment thesis moving forward.
Sure. Lay it out.
In the manufacturing sector, sudden surges in technology demand, like the current AI infrastructure build-out we're seeing, often trigger what's known as the bullwhip effect.
Right, where procurement managers basically panic about supply chain constraints.
Exactly, they panic. So they place massive redundant orders, or they schedule deliveries 18 months out simply to secure a place in the production queue.
Which creates a phantom backlog.
Yes, a phantom backlog that evaporates the moment supply normalizes. If Nordson's 18% backlog is built on those protective, long-dated phantom orders, this guidance raise is extremely fragile. Is this backlog actually going to convert to cash quickly?
It's a very fair concern, and the analysts on the earnings call relentlessly probed that exact vulnerability. But Hopgood completely dismantled the phantom demand theory by breaking down the conversion timeline of the backlog.
Okay, so what is the timeline?
Well, for their consumables and single-use products, which constitute roughly 60% of their revenue mix, heavily weighted in the medical and industrial divisions, those orders are converting to cash rapidly. Typically within the exact same quarter they are booked.
Okay, so the velocity of the cash conversion cycle is entirely intact there. No delays.
Entirely intact. And for the heavy capital equipment like the complex dispensing systems in IPS or the massive test and inspection rigs in ATS, the vast majority of those orders are scheduled for delivery within 6 months.
6 months is highly visible.
Very visible. Hopgood did acknowledge a very marginal fraction of orders bleeding into early 2027, but he emphasized that it is statistically insignificant. There is no fundamental change in backlog timing.
So this is not a defensive buildup by panicked OEMs.
Not at all. It is highly visible, structurally robust demand that Nordson is actively manufacturing and shipping to meet immediate customer capacity requirements. This is shippable backlog.
Which brings us to the bottom line for the portfolio.
The verdict.
Yeah. Synthesizing the margin defense we talked about, the highly strategic M&A with Capstan, the balance sheet engineering with the pension, and that verified 18% organic backlog growth. The signal from this Q2 transcript is heavily bullish.
Highly bullish. I mean, we are looking at a fundamentally de-risked enterprise right now.
Exactly. Look at their financial health. Their net debt is $1.8 billion, but their leverage ratio net debt to EBITDA sits at just 1.9 times.
Which is actually below the low end of their own long-term target range.
Right, so you synthesize the why here. You have an under-leveraged balance sheet combined with a company generating over 100% free cash flow conversion.
That generates immense optionality. They have massive dry powder to aggressively buy back shares, grow the dividend, and execute further bolt-on acquisitions without stressing the enterprise at all.
All while successfully battling intense industrial inflation. Naga closed the call by referring to Nordson as a quality growth compounder. And I have to say, the architecture of their current portfolio really defends that title.
It does. It's the synthesis of a defensive floor and a high beta ceiling.
To put it in plain language for you listening,
Yeah.
you hold the stock for the GDP plus stability of those consumer non-durables and precision agriculture. Those are markets that generate relentless cash flow regardless of macro volatility.
Right. But you buy the stock for the asymmetric, explosive offensive upside of the ATS segment, they are fundamentally embedded in the physical manufacturing bottlenecks of the AI revolution.
If the semiconductor industry continues to scale panel-level packaging and optical interconnects to solve the thermal and data transfer limits of AI compute, they simply cannot do it without Nordson's fluid dispensing technology.
And as management explicitly stated, they're only in the early stages of the semiconductor demand cycle.
But the broader market is so slow to update its priors. The algorithms and institutional screeners often still classify NDSN as a legacy adhesives and coatings manufacturer.
Yeah, so it gets priced against traditional industrial peers, which drags down its multiple.
Which presents the actual opportunity for retail investors. So I want to leave you with a final provocative thought to mull over.
Let's hear it.
With over 50% of their portfolio now heavily entrenched in electronics, semiconductors, and medical growth markets, and considering they are physically co-developing the optical fibers and panel-level packaging needed for AI compute, is Nordson still just a traditional industrial stock? Or is it actually a hidden backdoor AI infrastructure play hiding in plain sight behind a 50-year-old reputation?
That is the million-dollar question. If you believe the mechanics detailed in this transcript, it's absolutely the latter.
Exactly. Keep questioning those numbers. We appreciate you tuning into this Talk Tickers deep dive. Keep scrutinizing the transcripts, keep hunting for the mechanics behind the margins, and we will catch you on the next one.